Hello, I'm Callum Turnbull, Rural Business Consultant with Laurence Gould Partnership. Alongside my colleague Ian Thompson, I had the opportunity to co-author this management accounting guide for Monitor Farm Scotland. The purpose of this guide is simple: to help farmers turn their profit and loss accounts into a practical decision-making tool, rather than something that's only looked at once a year for tax purposes. In this video, I'm going to walk you through why analysing your accounts matters, how to understand your profit and loss, how to turn figures into decisions, and how you can use this guide and template to strengthen your business. Why analysing your accounts matters. Most farm businesses prepare annual accounts because they have to. They're essential for tax and compliance, but on their own, they're backward looking. They tell you what happened last year, not what's happening now. Management accounting is about using those figures to spot trends, understand where money is being made or lost, compare performance, and make proactive decisions. We often hear things like, "I've got an accountant, they deal with that. I can't influence most of my costs. The accounts show a profit, so things must be fine." But when you start analysing the detail, very often a different picture emerges. Profit doesn't always equal cash. Some costs are more controllable than people think, and small issues, if left unchecked, can grow into big problems. Good management accounting gives you clarity, control, and confidence, and that's what this guide is designed to support. Knowing your profit and loss account. Let's start with the basics. A profit and loss account shows three main things: income, variable costs, and fixed costs. Understanding each part is the foundation of good analysis. Income and output. Income includes livestock and crop sales, contracting and diversification, support payments, and other income. But we don't just look at sales, we calculate net output, which adjusts for opening and closing stock and livestock purchases. This gives a more accurate picture of what the business actually produced in the year. For example, if you've reared lambs that haven't yet been sold, their value still matters. Net output allows meaningful comparison between years and between farms. Variable costs. Variable costs are costs that change with scale. If you reduce stock numbers or cropped area, would this cost fall? If yes, it's probably variable. Typical examples are feed, fertiliser, vet and medicine, seed, sprays, and livestock sundries. Tracking variable costs per ewe, per cow, or per hectare is vital. In most farm businesses, variable costs should be around 30 to 35% of output. Significant deviations from that usually deserve investigation. Gross margin. Gross margin is calculated as net output minus variable costs. This tells you what each enterprise contributes towards covering overheads and making profit. It's one of the most powerful management figures available. We recommend analysing gross margin by enterprise, per unit, and year on year. It helps answer questions like which enterprises are pulling their weight and which ones are holding the business back. Fixed costs and overheads. Fixed costs are costs of running the business regardless of scale in the short term. They include labour, power and machinery, other overheads, and land, buildings and finance. Labour includes paid staff, casual labour, and ideally a notional cost for family labour. Power includes fuel, repairs, contracting and depreciation. Other overheads covers things like insurance, professional fees, utilities and office costs. Land, buildings and finance includes rent, repairs and interest. Although these are called fixed, many of them can be managed over time. Understanding them is essential. Depreciation. Depreciation spreads the cost of machinery and buildings over their working life. It's not a cash cost, but it reflects real wear and replacement. Including depreciation gives a more realistic view of business performance. Benchmarks. What are we aiming for? The guide includes benchmark ranges as a guide. Typically, variable costs should be 30 to 35% of output, gross margin 65 to 70% of output, fixed costs 45 to 55% of output, and net profit in excess of 15% of output. These are not rigid rules, they're indicators. If your figures sit well outside these ranges, it's a signal to ask why. Turning numbers into decisions. The real value of this process is not filling in tables, it's in asking the right questions. For example, which enterprise carries most of the overheads? Are costs rising faster than output? Is machinery underused? How dependent is the business on support payments? Can the business comfortably fund family living and reinvestment? These questions help identify pressure points, inefficiencies, and opportunities. The process we recommend is start with output, then look at gross margin, then review other income and analyse fixed costs. Finally, take a step back and look at the whole business. This structured approach prevents jumping to conclusions. This guide is designed to be used regularly, not once and forgotten. Each year we recommend reviewing your P&L, comparing 3 years, breaking down by enterprise, calculating margins and benchmarking. During the year, track major costs, monitor cash flow, watch for pressure points and reforecast if required. Best practice includes consistent coding, simple reporting, external input where helpful, and sharing figures with business partners. The aim is steady improvement, not perfection. Useful tools. The guide introduces several practical tools. Gross margin analysis isolates enterprise performance. Sensitivity analysis tests what-if scenarios. Benchmarking compares performance with others and with your own history. Scenario planning looks ahead before making changes. Partial budgeting tests ideas before committing money. These tools help to reduce risk and improve confidence. Case studies. The guide includes real-life case studies. Farmer A shows how inconsistent output can be undermined by high variable costs. Farmer B shows how good margins can be offset by excessive overheads. The key message is, it's the process that matters, not just the figures. Once you understand how to analyse your own business, you can apply the same approach regardless of the system. Common questions and concerns. Many farmers feel this process looks daunting. That's completely understandable. The advice is, start small. Break down one enterprise, track one key cost, set one margin goal. If the figures don't look good, that's not failure, it's information. It shows where attention is needed. Support is available through your consultant, accountant or Monitor Farm Scotland advisor. You don't have to do this alone. Using the template. Alongside this guide, we've developed a practical management accounting template. It helps you input your figures, calculate key metrics, compare performance and track change over time. We strongly recommend using the guide and template together. Keep your accounts to hand and work through them side by side. To finish, I'd like to emphasise one thing. This guide is not about producing perfect accounts, it's about building understanding. It's about being in control of your business, it's about making informed decisions in an increasingly challenging environment. Small regular reviews make the biggest difference. This guide is your starting point. Use it to take control of your figures and shape the future of your business. Thank you for watching.